Hi, I'm Todd Rosenbluth, head of ETF and mutual fund research at CFRA, and I'm joined by James Davolos, portfolio manager of Horizon Kinetics Inflation Beneficiaries ETF. James, thanks for joining me.
Thanks so much for having me. Really happy to be here today.
Our pleasure to have you. So your fund, INFL, has been one of the most successful ETF launches of 2021 with over $600 million already in assets. But let's talk about what's the backdrop of this. There's a lot of debate around defining inflation. What's your view of CPI as the definition of inflation?
I think that's one of the most difficult parts for investors and consumers to wrap their head around is what actually is price inflation, because a lot of people's living experience over the last 3, 5, 10, 20 years has not reconciled with an average of 2% living expenses. So two obvious outliers I think that you can point to today would be healthcare expenses and higher education. So it's really difficult for people to think about CPI and also think about their current living expenses. And that's why we orient this fund towards markets that we believe are a bit more inflationary and are not subject to a lot of the adjustments that the government imposes on CPI. And quite honestly, it's beyond the context and the time of this conversation, but the calculation of CPI itself is actually quite controversial, and both academically and professionally. So I think that you need to be very holistic and understand where you think inflationary forces are going to be in the economy when designing a portfolio and an investment strategy to combat potential inflation.
So let's just talk about how the portfolio is constructed. Many people are using tips or direct investments into base metals or natural resources companies in order to get exposure to this. But that's not what's inside the portfolio. Let's talk about what you've chosen to be inside INFL and why you think that best represents the way to benefit from inflation.
Sure. And right off the bat, I think that when you look at trying to hedge or to combat against something that you view as a risk, the most natural place to look is fixed income. But the big problem with tips is twofold. One, right today, as it stands today, the 10-year, you've got over a negative 1% gross yield. So what that means is if you hold a tip to maturity, you're still going to have a negative real rate of return because you're buying in at a negative over 1% yield today. But it's also linked to CPI. So the absolute level of rates being so low, as well as how flat the yield curve is today, and CPI as a construct itself, almost eliminates fixed income as a way to benefit your portfolio, because in my mind, best case scenario, these types of instruments could maybe stay still while everything else is collapsing. And what's really the benefit of that? You could really hold cash, or you could hold anything else that might basically preserve value. The other area to look might be into direct commodity investments or into commodity producers. And commodity futures and spot commodities are very tax inefficient. It's very expensive to hold that positioning. And then the producers are extremely capital intensive. And what I mean by that is they require a lot of working capital in order to achieve their returns. So you spend a lot of money to make money. Let's just look at a copper mine. You might spend 15 years and $1 billion to dig up that mine before you're cash flowing. And due to the nature of that cash flow and capital intensity, you also have balance sheet risk. So you have two forms of capital intensity, which really prohibit you from compounding over a long-term cycle. And so we really view both tips and commodities and commodity producers, and for that matter, listed infrastructure and real estate, as more of a directional binary bet on inflation. The way that we solve this is we focus on companies that have exposure to hard assets in inflationary end markets, but with capital light business models. So what I mean by that is they don't need to spend a lot of money to earn their returns. So they have a lot of scalability or operating leverage. And because of this nuance of the business model, they don't need to use a large amount of leverage. And so this de-risks the business on both the down cycle and the up cycle, and really facilitates a company that can compound over a full or multiple business cycles where you're not making that directional bet on inflation.
So the way the portfolio is positioned, Does it play a role whether or not inflation is transitory or otherwise? I think that's a topic of debate within the marketplace.
Yeah, and I think that's a great example why you don't want to make that binary bet on inflation. Because in our portfolio, I think to actually take a step back, the debate isn't is inflation transitory or is it structural? We know that we've already reset to a much higher base level of prices. Just this morning, Walgreens announced that they're taking their minimum wage employees to $15 an hour. That's a 10% hike over federal minimum wage, and you're never getting that back. Same thing with a lot of these supply chains and a lot of these channels where we've reset to a much higher level. So if you're betting on CPI sustaining at 4, 5, 6%, you're basically betting on this rate of change continuing. Our portfolio is actually going to benefit from this reset because the companies that have exposure to copper, iron, agriculture, brokerage, commercial real estate, healthcare, they've already reset at a much higher level of pricing, and they have little to no commensurate force in terms of their costs. So we've already reset at a higher level. So it's not necessarily all that important to us whether we sustain at a much higher level. Obviously, we think that our channel rates of return would be much higher as you get higher and higher out onto the inflation spectrum going forward. But I'd be remiss if I didn't say that we're pretty convinced that inflation is going to be structural and not temporary or transitory. And there's a lot of reasons for this, but first and foremost, this is a supply crisis, not a demand crisis, or shock, I should say. The Federal Reserve and politicians and even a lot of economists and investors are viewing this as a classic demand shock. So there's an economic shock, demand gets disrupted, you need to stimulate demand, demand comes back. We're experiencing a supply shock where supply chains, the ability to do business, the ability to produce these goods has been severely interfered with. And so the fact that you have these trillions of dollars of fiscal stimulus coming in, much of which is still sitting in M2, which is not productive uses. Once that actually flows through into the real underlying economy, I think you're going to have much higher CPI numbers and a much more sustaining price pressure throughout the entire economy.
So we're talking about how you're using equities in order to focus on the inflationary markets. But where does this fit into an overall portfolio for an advisor? Is it on the equity side of the ledger?
I think it really depends where an advisor or an investor sees inflation risk within their overall asset allocation. And personally, I think it's a very large risk because most people have enjoyed tremendous returns over 3, 5, 7, 10, even 20, 30 years in quote beta. But they've also done incredibly well in long-term bonds. If you own the ag or high yield or even 30-year treasuries, you've also done remarkably well. And you've had very high correlations. And the commonality here is that you've had declining rates from the middle of the 80s all the way through today to zero, basically buoying equity multiples and bond prices. That's pretty much not repeatable. So to the extent that you're worried about inflation influencing the long end of the curve or interest rates, your SPY, your QQQ, your HYG, even your AGG, all of these short-term, intermediate, high-risk bonds, and then equities, especially with the multiples you're paying today, have a tremendous amount of interest rate risk. So we view our fund in two ways. INFL is a complement to traditional beta, where there's potential for these companies to act very differently operationally from the broader economy and the broader benchmark. But also our trailing yield is about 2%. I would argue that it's somewhat inflation indexed. So that actually compares favorably to the yield, certainly in the investment grade arena. But if you're able to basically understand and tolerate the volatility that comes with equity. So it can be used in many ways, depending on exactly where you view risks as lying and how your asset allocation is positioned today.
So the product's been live for just under a year. We've got live history to be able to work with and a portfolio to understand. How has the turnover been within the portfolio, and how are you managing position sizes?
Sure. INFL is a creation of Horizon Kinetics, which is a very long-term buy and hold. I'd call us an eclectic value firm where we're not beholden to any one valuation framework, but the name Horizon Kinetics stems from extending our time horizon, where we want to earn the underlying business returns over 3, 5, 7, 10, ideally infinite period of time. And that's very tax efficient, and it really permits your portfolio to compound upon prior gains. And this INFL is really no different. So year to date, we've had minimal to no turnover. Obviously, the fund is still pretty young, but we limit positions at cost at about 5%. And then we're never going to let a position run above about 7.5%. And the reason for that is twofold. One, we really want to have a broad net to capture many nuances of inflation. I mentioned before, inflation is a very complicated topic, and there's a lot of different areas where it can manifest in the economy. But we also don't want to have necessarily individual stocks driving the performance, where we have a very strong fundamental view on a valuation standpoint, on a business model standpoint. But again, we want to give a very broad exposure to these inflation variables. And so at cost, you'll max out at 5, you'll max out at 7.5 at market. Position sizes range from 2 to 5. And today we've got about 35 names in the portfolio. And as I said, minimal turnover, at least on the trailing year basis.
Well, thanks, James. I think that gave a great understanding for our audience about the inflationary markets, what's driving it, and how your portfolio, INFL, from Horizon Kinetics, is offering exposure to benefit from these trends. Thanks for joining me.
My pleasure. Thanks for having me.
And thank you for everybody listening in. Have a great day.